Hello everyone. We're back here with the BYOB podcast where we talk about becoming your own banker, and also we feature businesses locally in our area by bringing a drink and having a good time, having a great conversation. I'm your co-host David.
And I'm Josh.
And today we're going to talk about the ideal asset, how to have a conversation, how to think about what you would do, how the mental process would be to determine whether an asset is working for you based on the criteria you use and based on the characteristics you use. So today, for our sponsor, we have
Four Silos Brewery and Coffee Shop, located in Gilbert, Arizona. We grabbed lunch over at Four Silos the other day and had a great time on their patio. Very laid-back environment, great drinks, great food.
Great food. Yeah.
The beer was awesome too. So we've got their woodshed wall up here.
Yep.
But just a little bit of history about Four Silos. It's owned by a family who lives in the Morrison Ranch neighborhood, which is a very very nice part of Gilbert, and the name comes from four silos that were on a farm here in Gilbert that has since turned into a residential area. But the farm said, we'll sell you this land, but we got to keep the silos there as a token of what this area used to be. And the family that started Four Silos Brewery and Coffee really respect that heritage of the farm and wanted to carry on kind of that image and legacy. So we're happy to sponsor them today and give a shout out to Four Silos.
Yeah, and just to be clear, the businesses we feature, the only purpose we do this, there's no sponsorship and there's no cost. We, as our mission, individually for our business, have as a mission to support the local economy, the local businesses, and as a matter of fact, we serve business owners around the United States. So for us, the intent is, hey, the things that we're enjoying, the things that we want to contribute, if you're a viewer and you want to pick a spot for lunch, take your family, hey, this business, locally owned, family owned, is a great option. So hopefully there's more benefit and more growth for the local community here in Gilbert. So
absolutely.
Let's do a quick recap on the previous episode, because I think it's important that we talk about a couple of things there, just so we can see how we connect the trend of our conversation. So what did we talk about last week?
We talked about the flow of money. So money is always moving. Money, if we're going to the bank, making a deposit, that bank is then taking that money, lending it out, charging interest, while paying us pennies for depositing that money with them. So we talked about the saver consumer type dynamic and how we can possibly remove the bank from this equation, become the bank ourselves, and then recoup that interest into our own personal or family banks in order to maintain control of that money.
Yes. The other thing we talked about was the focus on cash flow. And with that is, hey, not only in the short term, the trend for how money flows through most people is either they use debt and then they repay the debt, or they accumulate cash and savings and then they deplete it back to zero, which is this graph here. You are living a life that your money always goes back to zero versus the mentality of having your own bank and having a system that never interrupts the compounding on your money. And then in the long term, the mentality of the nest egg, I'm going to, over my working life, 30 years, 40 years, whatever it is, accumulate an amount of capital that then I'm going to drain in retirement. And that mentality, again, goes back to zero versus creating a system focused on cash flow where you accumulate assets that get more efficient and better over time, and that generates the opportunity to create wealth, not just for yourself and your lifetime, but for the future generations. So that's what we're all about.
Right. It's a matter of asset depletion or asset accumulation and cash flow growth.
Absolutely.
So the nest egg focuses on build that up and then deplete it over time versus how can we redirect that same money into something that over time is producing more cash flow, which then provides us financial freedom.
And I guess one last disclaimer, whatever you're doing, wherever you are today, just realize that the opportunity to go from one side of that equation to the other, it's always there. And Absolutely. It starts by taking control of the banking function in your life, in your business, for your family. You can always make things better by adding small steps in how money flows through you, so you can now get that capital working for your behalf. So I think that's a great recap. It was a really great idea. It's very fundamental to what we talk about. And now it connects very importantly with the question we have today. what would be the ideal asset? What characteristics would we find in there? So let's jump right on.
Yeah, so the ideal asset, we've got a nice list here of, what do we got here? 16 different items, David?
Probably,
14? I
yep.
can't count that fast. But
16,
a bunch
yeah.
of different items on here that when we're looking at different areas to put money, whether it's investing, saving, speculating, what should we take into consideration with these different areas? So you all can read. We don't need to list everything off here, but a few of the things that come to mind that we hear most frequently is what's the rate of return? How safe is it? How liquid is it? And what is how do we use it?
Yeah.
Ultimately,
Yeah. What's the purpose?
What is the purpose? How does it function? That kind of stuff. So we'll put up several of the most popular asset classes up here, and just kind of go through this list and figure out what are the pros and cons of these different assets or savings vehicles, or is it best to just keep cash in a coffee can or under the mattress?
And I think a healthy way to think about this is there's no bad or good, because that's a black and white way that it probably doesn't serve most people. I think the nuance is in learning how to think about things, right? It's not just saying, oh, this is bad or this is good, because the question that comes out of that statement is for who and when. And if you think that there's no people making money in a particular asset class, you're probably wrong.
Right.
Because just like Warren Buffett may be making billions of dollars through the equities market, for the individual that is not an expert, doesn't have an edge on that market or in that asset class, it may not be the same, right? It may not be as useful in their purpose or in their goals. So with this, what we're trying to do and accomplish is maybe give you a couple of examples about how we think about a list of characteristics. You may have a different list for your situation, your goals, and also how do you evaluate different asset classes. So let's jump right into how we frame this conversation. So we have a table here, very simple table, and we have a couple of examples of asset classes. We have stocks or equities, we have bonds, we have real estate, we have precious metals, gold and silver, and we have cash, liquid cash. And then the list that we had in the previous page will be in each line item. So we're going to have a quick conversation, and we'll start talking about, hey, how does it apply for these different asset classes? So you can start to think about, hey, I'm interested in cryptocurrencies, whatever it is. How does it serve in a list of characteristics that I would want to have for the purpose of saving or for the purpose of investing, or even if you want to speculate?
Right.
Okay?
And the whole purpose here is to increase financial IQ.
Absolutely.
Because
Absolutely.
the more we know about what we should be looking at, the better decisions we're able to make. And again, these are just 5 of the most common items.
Yeah.
And depending on experience, depending on knowledge, depending on who you're possibly working with, one of these might be better at a certain season of life than another. And ultimately, understanding what that goal is and the steps to take to get there is more important than anything on this list.
Absolutely.
Because if your goal is much shorter in term, then buying real estate might not be the best thing because of the cost of sale and the time it takes to procure and close on a sale and actually sell the property. So each one of these might have pros and cons depending on the ultimate goal.
We're also generalizing, right? Like if we just pick a single category here, real estate alone, if we now go into a higher level of sophistication, we could talk about commercial, residential, industrial, then we could talk about submarkets, then we could talk about other instruments, tax liens, blah, blah, blah. So we understand that what we're doing is a simplified version of maybe for some of the audience, the conversation you would want to have. So again, our objective here is more of the process of how we think about this thing, so you can go in detail into what you actually are trying to accomplish and have a similar analysis. So should we get started?
Absolutely.
So the first thing that is the most popular thing people want to think about when they think about investing in particular is, do I have a high rate of return in this asset class? So how do you think through that in these examples, Josh?
How I would consider this is historically looking at these different asset classes, what has that average rate of return been? The commonality within stocks and real estate is long-term appreciation, somewhere in the realm of 4 to 8% is fairly common. And do the other items on here compare to that range. Now, obviously, depending on which stocks you pick, which real estate market you pick, is going to affect that rate of return. And also how hands-on you are with it. So again, we're generalizing here. Historically, stocks and real estate outperform the other items on here. Cash, does not have a rate of return. It's whatever the inflation rate is, and you're probably losing money by just holding cash.
Yeah, and like you said, there's variation. Like if you pick the right period of time adjusted for inflation, you'll find that gold may outperform. Of course, we understand that, but in general, like you said, when we think about going after appreciation on our capital through returns, we probably would look at an asset like equities compared to bonds to think that that will yield higher returns. So
Correct.
That's how we would think through that characteristic for these asset classes. Let's pick a second one.
Consistent rate of return. I'd like to think of this more as a guaranteed rate of return. We know that it's going to perform this way indefinitely, and none of these meet that. Bonds might be the closest because when you buy a bond, there is some kind of rate attached to it. However, that bond rate is always changing, and it just varies depending on when you bought the bond, how long that bond term is. But everything else on here is very fluid as far as what that rate of return is and how consistent you can expect that.
Yeah, and it's interesting you bring that point of view. Like when we think about time horizons, right? Are we thinking about a month? Are we thinking about 30 years? That will change the perspective on the analysis. But in general, the message here is that none of these assets have a guaranteed consistent rate of return because the market will fluctuate for all of them. So is there other asset classes that provide that characteristic if this is something that is important to you?
Right.
Okay. What about conservative safe? How do you think through that?
That would be more of the historical look at this as well, of looking over the last 30 years, how many times has a specific market crashed, or how volatile is it? What kind of economic factors are influencing these different asset classes here? So this would be, can you go to sleep at night and not be worried about the volatility in that market? And stocks, I would argue, have the highest volatility simply due because of the different market influences, the economic influences, trade influences. There's so much that dictates business operations rather than simply buying a municipal bond or government bond, or buying real estate in your market. Because if you look at your individual market, you can make a much better prediction on a local level than if I say all of American real estate.
Right.
So that's where the local level would be fairly safe and conservative because you can get very detailed as far as what's going on in your backyard.
Yeah.
But if I generalize that for all of North America, real estate might not be the most conservative, safe thing because of the economy as a whole. So that's where I'd argue you need to get to a specific local level.
What instrument you're using to express whatever view you have about real estate.
Correct.
A single family home in your backyard versus buying a security that represents the overall United States real estate market. Yes.
Correct.
Yes, and that's also a great nuance that you bring here, because the definition here of conservative and safe also applies to what are you trying to protect against? What is conservative to you in your mind? So for the precious metals, the argument in a lot of this conversation says, no matter what happens, if I have control of that physical ounce of gold and is in a safe place, in a safe box somewhere, whatever the economy does, eventually that precious metals will adjust for the purchasing capability I have with that versus dollars or whatever, right?
Right.
So absolutely. And then in terms of cash, there's no volatility, right? You have the cash. Inflation could be the potential downfall for it.
Correct.
But it's available and liquid, so you can take advantage of opportunity.
It's there. I could always use it. It's, unless the government, seizes bank accounts or something like that, like it is considered to be a safe source of funds.
Yeah, absolutely. Okay, let's go to the next one. Liquidity. This is one of my favorite things. I've now come to realize that is a lot more important than I realized in the past, because having an asset appreciation or a balance on a digital website of whatever asset I thought it was growing and make me feel happy, actually sometimes doesn't counter the fact that liquidity might be more important in emergencies or when taking advantage of opportunity.
Right, and liquidity would be how quickly can you sell or exchange that item for cash that you can go spend anywhere.
Yeah.
So stocks, it's typically within 3 days of selling a stock, you could withdraw those funds from the account. Bonds, similar situation. Real estate, though, unless you've got an investor who's closing tomorrow on something, you're putting that property on the multiple listing service. You're waiting for showings. You're waiting for escrow, lending, that kind of thing. So that timeline is much longer and will not be liquid. The alternative is, can I leverage that real estate through a loan, a HELOC, something like that? But again, that's going to take significant
to
time
the other ones, it's
relative
less
to the couple days it would take to sell and transfer funds for stocks, bonds, gold, silver. You go into the local gold shop, sell it, get cash, right then. And then cash obviously is liquid. We can go anywhere and spend that.
Yeah, I would put the caveat that in terms of liquidity, obviously the trend that the most liquid will be cash. I think precious metals will be right next to it. And then these two, pending you have a buyer, would probably have a more efficient market to access liquidity than something like real estate. So perfect. Okay, so something important to think about. Where's your allocation over all the money and all the capital you have? Where, are you 80% cash? Are you 80% in real estate? Are you 100% in real estate? And how does that affect your liquidity? If liquidity is important for you, this is something to think about. How the allocation of capital and where capital resides is going to be important to have that liquidity part of your strengths. Guarantees.
So guarantees would be, we know always how that's going to perform. There's no deviation from the plan.
There's a contract associated to it.
There would be a contract guaranteeing a rate of return. Now, we could argue potentially in the real estate realm, if we're the lender, then there is a set interest rate that would essentially be a guarantee to us. And if that's not being met, there's foreclosure, you get the property, and there's another kind of guarantee there. But if we're holding real estate, there's no guarantee at what that rental rate is going to be. There's no guarantee for the appreciation. And then same thing with stocks, bonds, gold, silver. We don't know how those values are going to fluctuate. We don't know what that's going to be worth in a year, let alone tomorrow. Now, cash, potentially guaranteed, because it says right there, this is an IOU.
Yep.
And the only thing that could possibly hinder that guarantee would be bank runs, something like that, where you can't access your account. However, the rate of return on cash is zero. Like it's not making you more money. So that's where the guarantee is like, well, it's guaranteed to be there. But it's not guaranteed to do anything.
May be different, and then you can start to see through Josh's conversation here, like how the interaction between some of these things now create a whole different point of view, right? Yeah, I may have guarantees, I may have liquidity, but what is happening to my purchasing power if I'm 100% in cash? That's how you start thinking through what, in service of what you're trying to accomplish, what would be a good combination of characteristics for a few of these ideal assets for warehousing holding capital. So perfect, that's a really great point. A couple more here. Tax benefits, tax-free. We can go a little faster through this, but...
so this would be looking at if I own these different assets, is there any tax benefit as far as deferring taxes on those capital gains, that kind of thing. So the only thing that comes to mind with this one would be like a 1031 exchange through real estate. You're deferring those capital gains by buying other real estate. If you're holding stocks, bonds, gold, silver within an IRA, 401k, something like that, then there could be some tax benefit. But for a typical brokerage account, it's not going to be there.
And relative to each other, again, probably real estate will offer most of that. If you have more sophistication in your system and you can do cost segregation in commercial properties, things like that, right? That we can just now say, this would be an asset class that would be very beneficial compared to the rest.
Right.
So that's another one. Market volatility.
Yeah, we kind of touched on this already. It's just what is going on? What are the outside factors affecting the performance of these different asset classes? Yeah. This kind of goes back to the guarantee. If there was a contract dictating specific terms of this asset, then we know there's no volatility there. It is guaranteed return, as opposed to outside factors affecting stock prices, gold, silver, all of that kind of stuff. So, if it's a contract, there's no volatility. If there's not a contract, then there's all kinds of influences that could affect the value of these different items.
And this is not to say that it's bad or good, because if I'm in the mindset of investing and I like volatility, because in periods of volatility is where I can capture large gains.
If you're a day trader, you want market volatility.
Exactly, because then that's opportunity. It just happens to be that it has to be your situation, that you're capable and armed with the right tools.
So this isn't necessarily a bad thing.
Absolutely, not at all.
It's how do we assess this and our personal strategy to grow our wealth.
How does volatility creating upside or downside, and how we manage that for asset growth? Is it a characteristic that I want in my assets for saving? Probably not. Investing, perhaps. Speculating, well, that's for the people that like gambling. But one more thing. The other thing about this is that you can assume that markets accurately express what's happening with an asset class. But I would argue, and we don't have to go in depth into this today, that things like assets like equities could be also impacted by forces that we don't see. Mm-hmm. The fact that a business is more productive doesn't mean that the equity markets is reflecting the right valuation, because the Fed could be affecting that. Buybacks could be affecting that. So we live in a world today, unfortunately, that there's outside factors that also affect that perception. That's why we have these crazy markets today. So in terms of that, I would also say certainty may be something you're looking for where you warehouse your money, and that would be a great consideration to have in mind. The last one here, yields income besides capital gains.
So in short, this would be dividends or rental income. So the only place we're going to see that, stocks, bonds, real estate, somebody's paying rent, then you're getting income outside of just the gain in value over time of that.
And I would argue that we call that here cash flow.
Cash flow.
So this is one of our favorite things to talk about. When we're talking about investing, we should be doing it with the mindset that we're generating cash flow, because that's the part that matters to affect the quality of your life, the quality of your finances.
Right, yep. If we're parking money somewhere, we want to make sure that there is cash flow taking place as opposed to just asset appreciation, because we ultimately can use that cash flow, we can reinvest it, we can make it work harder and faster for us if we're in control of it.
That's why banks and businesses focus on that. So, okay,
absolutely.
A few more. Creditor protections.
Nothing. All of this, if you were to go file bankruptcy, you have to declare these different assets. If you go and get your credit pulled because you want to go get a new loan for something, they're going to see your different mortgages, that kind of stuff. So in short, if someone were to sue you, they're going to have access to any and all of this, unless possibly it's within some kind of trust.
If you have sophistication from an entity perspective, but even then, they will be likely things that are exposing brokerage accounts and other accounts.
Right, yep. Right. So if you're worried about creditor protection, definitely speak with an attorney in order to structure that for you. The best case scenario would be some kind of asset that is privately held that does not need to be declared.
Right, absolutely. Inflation protection.
So inflation, as we know, is the cost of goods is increasing. So we want to make sure that where we're parking our money is increasing at a similar, if not faster, rate. So that's where the protection would be, that the value of this is going up faster than the rate of inflation. Typically with real estate, we see that even in a down market, typically home prices are increasing at the rate of inflation. We could also argue that having a mortgage on a property, because that interest rate is set, is a great hedge against inflation, because you're getting money at today's dollars for the next 30 years. So as that value of the dollar gets weaker over time, I still borrowed money at yesterday's rate. So real estate would be the ideal one here. Gold and silver, historically, are a great way to protect against inflation. Stocks, possibly, just depends what's going on in the market.
Yeah.
Bonds,
Yeah.
again, it depends on how you buy
It's an
them.
arbitrage, so it depends on where the rates are.
Right.
But in general, I say that protection would be in those two asset classes. I agree.
Absolutely.
Control.
We can control all these to an extent. We can dictate what stocks and bonds we're buying, what real estate we're buying, the price that we buy or sell gold and silver at. We're able to affect, these to an extent. I would say that arguably the best control would be over real estate, because even if the market is misbehaving, I could personally go and work on that property in order to control, to an extent, its value.
Yeah.
And
much harder to do with buying a corporation stock and trying to affect the price, right?
Right.
As a single retail buyer, even institutions probably would have a lot harder time affecting the bond stock market as a small player versus you individually having additional control over what happens in something like real estate. I totally agree. So some nuance there on the difference in control between the different asset classes. So something to think about when you're thinking about what asset class would serve what purpose for you. Transferable, that's an easy one.
All of them, because if I pass, my heirs get it, and that's going to hold true to all of these.
Yep, the IRS will get it too. Easy to manage.
We kind of touched on this already. How difficult is it to log into a stock trading account and hit buy sell? Pretty easy. Same thing with bonds. Same thing with gold and silver. You go buy it. Real estate, can be harder. It just depends on your financial IQ and your experience with it. I would make the argument of it's easy to manage because I could hire a property manager to take care of it.
There's vehicles to execute on that. Yeah.
Right.
Yep. And I would say manage from the logging into an account on a brokerage. Yeah, that part is easy. Understanding how to actually manage a portfolio to control value, to control growth.
How to make it grow is going to be harder.
So,
but the ability to log in, buy, sell, trade is easy.
To manage the ownership of it.
Correct.
They're all very easy. Okay. I'm going to roll through these last ones. Reputable, private, and no hidden fees. So what do you think?
Fees, penalties, as far as being hidden, stocks and bonds, as long as you know how you're buying them and whether or not they're within a retirement account, if you withdraw the funds of a retirement account, you're getting dinged a penalty. So that might be the hidden fee. That's why I put a question mark there.
Yeah.
Real estate, you've got, with a closing, you've got commissions, you've got repair allowances, you've got seller credits potentially. So there's a lot of things you might not think of when you go buy it, that when you go sell, you're like, hey, I was expecting a net 100,000, but I only got 80.
Yeah.
Because of all those different fees. Gold, silver, there's nothing really there. You go exchange.
The premiums on gold and silver, depending on how you buy, could be large enough. So people get surprised with that in liquidation times. But yeah.
Sure.
Yep. Reputable, depending on what you use, who you use, how you do the acquisition and the sale.
Right, and even the history of investing in these. If we put crypto up here, it's going to be an X.
Yeah.
Not as reputable, hasn't been around as long.
Yep.
The level of understanding isn't quite there for a lot of people. But most everyone who understands money is going to understand these different asset classes. So that's why they're reputable.
And private, I think that you talked about that earlier, but probably the safest in terms of privacy would be, having a physical piece of gold or silver or precious metal that's in a safe or in your home, and nobody has to know about it. It's not disclosed to the government. So
correct. Yeah. Real estate, I could log on to the county assessor, enter in your name, and know exactly what property you own.
Yeah.
That is not private at all.
Yeah. Even with sophistication, if you have an LLC, there's public record of it.
Right. Right.
Okay. So hopefully, this list of features, characteristics, give you insight into how to think about evaluating a list of assets that you want to use for the purpose you're trying to accomplish with your financial life. And this is just our list. Feel free to add, remove, whatever it is that you're thinking that is important to you. Add it to there, get a bunch of assets, and start thinking, how does that work and how do they work in between them? And use the filter that we always talk about, savings, investing, and speculating. When you save, you're talking about capital that you want to preserve, that you don't want to interrupt the compounding, and that you cannot afford to lose. Therefore, there should be no risk associated to that. If you're investing, now we're talking about, okay, I am willing for a period of time to part away from my capital in order for my capital to go to work, but I'm going to do it in a way that as I seek growth in that capital, I understand the risks, and I have a way to control at least a portion of that risk. So it's not a speculation, which is our third, but it's an actual investment. I have the ability through my knowledge, through my tools, my systems, to have a hand on how I manage and reduce that risk as I seek that opportunity for a period of time.
Right. The true difference between investing and speculating is your knowledge of that investment.
Yeah.
If I go buy crypto,
Yeah.
I'm speculating. I don't know jack about how it operates, what affects its value, that kind of thing. I know a lot about real estate, so that would be for me, a safe investment because I understand how it works, how it operates. So whatever investments you might be pursuing, make sure you have the knowledge to really understand how it works, what could affect that value over time, et cetera. And all of these we take into account because we want to know if I'm putting my money here, whether I'm using it as a savings vehicle, whether I'm using it as an investment vehicle, whatever that might be, we need to know how can I re-access that value? What is the liquidity? How can I make sure that it goes to my heirs? Things like that. So again, this isn't a whole comprehensive list. This is the bare minimum of what I would say you need to understand with any of these asset classes, because whether I'm looking for the ideal place to park my money as a savings vehicle, or where I'm looking to invest my money for long-term growth that might have increased risk, I need to understand how these operate in order to make that best decision.
And the truth is that what you said is super powerful. Two people can be buying real estate and one person can be speculating and you could be investing. So in addition to going through this thought process, make sure you understand also where you are in your journey, in your financial IQ. Have you understood enough? Have you learned enough? Have you partnered with the right people that can guide you through the right process? Because it's very important that you become the person capable of investing.
Right.
And for savings, it's very important that you become the person capable of managing the banking function. So with that, we'll leave you with the thought of focus on cash flow. Make sure you understand where your savings resides and how much you're saving so you can go and take advantage of opportunity and be prepared for whatever comes with life. So thank you for joining us today. We look forward to seeing you in the next conversation where we talk about how banks work.
Absolutely.